Two quality stocks to buy near their 52 weeks low. I've been doing this video for the last few weeks of going on a screener, looking for stocks trading near their 52 weeks lows and trying to analyze them, see if it's presenting an opportunity. And 2 months ago, I did find FICO near its 52 weeks low. A lot of you guys have thanked me for those videos, and maybe my FICO analysis has helped you with your own analysis and your own research, which I'm very happy to hear. And this is why I've been doing this for many years, where I go on a screener and I look for stocks trading near their lows on Saturday and Sunday and try to see if this is maybe a hated, misunderstood opportunity, or maybe it's just a value trap and it's something that I should avoid. But I have two very interesting stocks for today's video, and the second one is my favorite because it's a misunderstood company amongst the retail investor community. They believe it's dead, no one drinks their product anymore, mature company, declining volumes, all these things. But all of them are not true. And I'm gonna teach you a few things about the business model, which I believe might surprise many of you. So I hope you enjoy it as always. The first one is NVO, Novo Nordisk. It's down 48% over the last year. And this is again a short overview, so it's not a deep dive by any means. But I believe there's many potential tailwinds coming for NVO. One of them, which came out recently, Costco is gonna sell Ozempic and Wegovy at a large discount into their stores for $4.99 per month for people without insurance. And this is, again, a major benefit in my opinion, because a lot of people have a Costco membership in the United States and even outside the world. And if they can get $4.99 a month for Ozempic or Wegovy, with going to the store, to me, this is a good proposition, and it could potentially boost NVO's revenues. But the real catalyst for NVO is mainly the oral GLP-1. They're going to be the first company. The first oral GLP-1 is going to be launched and made by NVO, which is going to be a game changer, as a lot of people, they don't like needles, they're afraid of needles, and they're not touching a lot of Ozempic and Wegovy for this reason. Well, the oral GLP-1 makes it maybe a little bit more convenient for a lot of people that care about weight loss or other kind of problems that are solved with those GLP-1s, and they can take an oral pill, which is, again, in my opinion, a game changer. But as I told you, NVO is going to be the first one to bring up the GLP-1 pill. The second one will be Lilly, but NVO is going to bring it up in late 2025, I believe in November, December, and Lilly is expected to have it online in mid 2026. So NVO is going to have the first mover advantage, but there's a lot of reports comparing the NVO pill to the Lilly pill. And it says NVO's pill is mainly a peptide medication. Eli Lilly's pill is a small molecule drug. That means Eli Lilly's pill is absorbed more easily in the body, and it doesn't require dietary restrictions like NVO's does. The Eli Lilly pill will also be easier to manufacture at scale, which is crucial as demand for obesity and diabetes injection outpaces supply. So NVO's pill is peptide, which I believe you have more diet restrictions. You have to take it in the morning on an empty stomach, and you can't eat for like 30 minutes or an hour. And Eli Lilly's pill is just not like that. You have a linear you have less restrictive diets for Eli Lilly, and you don't have to, not drink water or not do whatever or eat for like 30 minutes or an hour, and people might find it more convenient. But the report also states that it's going to be much easier to manufacture the Eli Lilly's pill versus the NVO's pill, which is why a lot of reports are expecting this market to grow to 24% of the total GLP-1 market, but they're expecting Eli Lilly's pill to have 60% market share, even though it's going to be a second mover, and NVO's pill is only going to have a 21% market share. Again, it's too early to tell, but I could see how this is possible if Lilly will launch 6 months in the future, but if it's easier for them to scale, if their pill is less restrictive on a diet than NVO, which people might prefer, something like that versus the peptide of NVO's pill. So I can see Lilly being a success, but NVO's 21% market share is really not bad, given that the stock is trading at 15 times and Lilly is trading at 25 or 26 times earnings. So a lot of those things are not just like, it's not like if Lilly has a 60% share and NVO has a 21% share, it doesn't mean that NVO is a bad company. It's also about how much are you paying for those fundamentals. And in the case of NVO, it's very, very cheap. Now you have more catalysts coming for NVO, and the end of the semaglutide shortage has been implemented. It ended in January. But I think the compounders like Hims and others, which they were selling a lot of the compounded GLP-1 for $100, $200 a month, I believe they stopped selling them in May. So NVO and Lilly should see a lot of the benefits of that supply coming offline in the second half of 2025 and the first half of 2026. It could again be a major boost on a comp basis for NVO and even for Eli Lilly. Now you have some potential headwinds, which is a Trump tariff at 100%, but a lot of people said it's pretty much nothing because it doesn't apply to companies building or are planning to build manufacturing facilities in the United States. So I believe NVO has facilities and is planning to build more facilities. So I don't think it's going to apply to NVO for now. We might have more of them coming into the future, but for now, it's really nothing for NVO. But NVO is a very high margin business. They have 35% net income margin. They also have a dividend. The dividend is 3%, and the free cash flow yield is 3.5%. So the free cash flow yield is more than enough to cover the dividend. And I believe the dividend, which is around 3%, it's actually a record high, is safe for now. And if you like the dividend, it's really not bad at all. But the real value creation relies on a massive change in sentiment that could send NVO's multiple back from depressed 15 times to maybe 18, 19, maybe up to 20 times. I mean, the company used to trade at 45 times 10 or 11 months ago, and the average is around 24 times. And it really never traded at 15 times. Normally it goes 16, 17, 18, but 15 times. And it went as low as like 13 times. I mean, that's absolutely ridiculous. So you're getting all this amazing company that's actually very innovative, 34% net income margin. You get a dividend, double digits earnings per share growth, and the potential of the oral GLP-1, which is a huge tailwind, and potentially NVO being innovative and discovering new uses for GLP-1 or maybe new products in general. 15 times earnings is not expensive, so I still like NVO very much at this price. Now, the second one, which is a hated company, but it's one of my favorites, and I haven't owned the stock since 2020, and that might potentially change very, very soon. And this company is Coca-Cola. Coca-Cola is down 9% over the last 6 months. It has not been doing too well. Coca-Cola has $30 billion brands, like multi-billion dollar brands, not just the Coke brand and the Fanta and Sprite, but they're actually big in water. They have Dasani in water. They have Smart Water. They have a lot of the Coke Zero stuff. I'm seeing them more and more popular. They acquired a lot of products like Fairlife, which I believe is in milk, and other energy drinks, Costa Coffee back in 2020. I mean, people keep on drinking coffee. So it's well diversified away from the traditional Coke product and soda consumption. And soda consumption is declining globally, but water consumption, coffee consumptions, and other consumptions are increasing in a major way, which is why Coke's volume growth it's actually still growing. It's not declining. They have 1% volume growth, 12% organic, and 7% earnings per share growth, which I believe is pretty amazing for a mature, you could say, company like Coke. And if you look at the Coke's volume in the red, and I can show you the volume over here in terms of unit volume, it only declined like 3 times 1% or 2%. And it's mainly been increasing 2%, 1%, 2%. But Pepsi has been decreasing or declining in volume growth for like 2.5, 3 years, every single quarter. Coke does not have this problem. So they can raise prices in a major way. As you can see here, they raise them, 5%, 6%, 14%, 15% at occasions, which is amazing. And they're still having, the potential tailwind of volume growth, 1%, 2%, which could be huge for a company with such scale as Coca-Cola. So this is a beautiful setup, and I'm very impressed with what I'm seeing with Coke. Now, the interesting part about the thesis is Coke has 26% net income margin. I mean, this is like a tech company. Tech companies, guys, have 30%, 30%, maybe sometimes 25% maximum. But Coke is having 26% net margin. This is insane. Now, why do they have 26%? I'm going to explain to you. But if you compare it to Pepsi, Coke has 26% net margin and Pepsi has 8% net income margin. This is a big difference. But I was thinking that it's just the same business model and they all pretty much have soda consumption, which is declining and all of that. Well, this is actually not the case with a company like Coke, and they have a different business model than Pepsi. Now, over the last 20 to 30 years, Coke has pretty much spun off their bottling investments and their bottling businesses. Now, most people believe that Coke every year they set the prices of the Coke cans that you buy at the store, but this is actually not true. The bottlers, which are independent right now from Coke, Coke has a stake in them and they control the voting power, but they don't really mess too much with the operations. They don't directly control it like Pepsi. So they are independent from the Coke company, the legacy company, and they are the one that are in charge of the distribution. They are the ones that are in charge of the packaging, and they are the one that actually sets the prices of the Coke cans in the stores where you go and buy them. Coke only sets the price of syrup every single year that is used to make the Coke products, that all the kind of other ingredients that are used to make the juices and other things. Coke only sets the price of them and they sell the syrup. And the bottlers, they do everything else, which is why Coke is selling like a subscription model. And every year they hike prices 5%, 10%, 15%. The bottlers take it, they manage it, they do a few things, and then they increase the prices at the store, and people pay up for the prices, and they've been doing it for 30 years, and they can likely continue doing so. And this is also a good hedge against inflation, as if we have inflation, those companies, they can raise prices 10, 15, 20%, and they have done it before. So this is again a beautiful model, but I still own a lot of owned bottlers, company owned bottlers, mainly in Africa, and they might potentially spin it off in the future. And once they spin off all the company owned bottlers, their net margins could potentially go beyond 26%, which is why it has very high net income margin. That's why it has higher net margins than Pepsi, because Pepsi controls everything and Coke has spun off the bottling operation, which is a good operation, but it's lower margins than just selling syrup. It's pretty amazing. Now, for a dividend yield, the dividend right now is around 3.5%. You can very rarely get Coke above a 3.5%. Sometimes it goes to like 3.5, sometimes it goes to 3.8, which is rare. It did go above that in March 2020, but that was a one-off. But anytime you're buying Coke above, let's say, a 3.5% dividend, it has historically been a good buy. And 3.5% dividend is very good for Coke. I believe it's sustainable. Sometimes they had free cash flow much higher than the total dividend paid. And sometimes, like in 2024 and 2025, it's been lower, sometimes because it's due to a lot of things within changes in net working capital, and they were a headwind over the last 2 years. It's expected to be a tailwind over the next 2 years, which is why the 2026 and 2027 are expected to be much higher in terms of free cash flow, and it should cover the dividend. But Coke, I believe they call it the dividend king or some kind of a dividend name, and they've been doing the dividend for many decades. I don't believe they're gonna sacrifice the dividend anytime soon. So I believe the dividend is safe for a potential return. The company is expecting 7 to 9% in earnings per share growth, and they have pulled it off over the last 5 to 10 years. I think they can pull it off again over the next 5 to 10 years. So if we take the mid-range of 8% in earnings per share growth, and we're taking in a 3.5% dividend, this is around an 11.5%, 12% potentially annual return from an amazing company like Coke. And you could potentially get a multiple expansion, because the company has traded as high as 26 times earnings, as low as 19 times earnings, and now trading at 21.5. Now, I prefer to buy it around 20, 20.5. It would be more ideal. But here at 21 times earnings, it could potentially go back to 23, 24 times. It's very, very possible. Or it could go up to 26 times. But I could highly doubt Coke going back to 19 times with such very high net income margins and such an amazing business model. So you could potentially get a multiple expansion above the 12% annual return, which could take it to 13, 14, 15%. So normally I use Coke and Pepsi and those stocks to park cash and move it around and do certain things. And I might do it again because I think Coke is looking very attractive over here. And I share everything I do in my own group. This is the link if you're interested. But I did like Coke very much. I like NVO. I think NVO has much higher potential than Coke, but Coke is more of a stable, recurring revenue subscription-like business model, and it's trading, a little bit less than fair value, more into the undervalued territory. So I like both of them. That was my update for Saturday. Not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.